Welcome back to Factful Finance. Have you ever heard of the term derivatives in the financial world and wondered, what does that even mean? Well, you're not alone. In fact, these financial contracts are a big part of the global markets, but many people still don't fully understand how they work or why they matter. Today, we're going to break it down, demystify derivatives, and show you how they fit into the bigger picture of financial economics. So, what exactly are derivatives? Imagine you want to buy a house. You don't have the money right now, but you make an agreement with the owner. You'll buy it in 6 months for a set price. Whether the market goes up or down, that's the price you'll pay. The contract isn't the house itself, it's the right to buy it under specific conditions in the future. That, in a nutshell, is what a derivative is. A financial contract that derives its value from an underlying asset or market condition. Now let's dig deeper. Derivatives are not investments in themselves, but they are linked to assets like stocks, bonds, commodities, or even interest rates. They can take the form of futures, options, swaps, and forwards, each serving different purposes in financial markets. Let's talk about futures contracts first. These are agreements to buy or sell an asset at a future date for a predetermined price. For instance, oil companies might use futures to lock in a price for oil months before they actually need it. This way, they avoid the risk of prices soaring in the meantime. Think of it as a kind of insurance policy against market volatility. Then we have options contracts. These are a little more flexible than futures. With an option, you have the right, but not the obligation, to buy or sell an asset at a specific price before a certain date. This is great for traders who want to speculate on price movements without committing to the full purchase. If the price doesn't go in your favor, you simply don't exercise the option. But if it does, you can profit handsomely. Swaps are another derivative often used by large institutions or companies. A swap is an agreement to exchange future cash flows based on different financial instruments. A typical example is an interest rate swap, where two parties might exchange fixed-rate payments for floating-rate ones. This helps both parties hedge against changing interest rates. Finally, we have forwards, contracts where two parties agree to buy or sell an asset at a future date for a price set today. Forwards are often used in foreign exchange markets, allowing businesses to lock in exchange rates ahead of time and protect themselves from currency fluctuations. You might be wondering, why do derivatives even exist? Well, the main reason is risk management. Businesses, investors, and even governments use derivatives to protect themselves against unforeseen changes in prices, interest rates, or other financial variables. Without derivatives, many businesses would find it difficult to operate in an unpredictable market. Take airlines, for instance. By using derivatives, they can lock in fuel prices and avoid the financial stress that comes with fluctuating fuel costs. But derivatives also come with a catch. They're highly complex and can carry substantial risk. During the 2008 financial crisis, for example, certain derivatives tied to mortgage-backed securities played a major role in the global market collapse. While they're useful for hedging risk, they can also amplify risk if not used properly. In fact, a little-known fact, some of the most sophisticated investors, like hedge funds and institutional traders, rely heavily on derivatives to increase returns, often with a strategy known as leverage. This means borrowing money to amplify potential gains. But if things go south, the losses can be just as magnified. So, what does this all mean for you as an individual investor? Well, derivatives are generally not something most individual investors use directly, unless you're dealing with certain financial products, like options on stocks. But understanding how derivatives function and their role in risk management can give you a clearer picture of how financial markets work, helping you make more informed decisions when investing, whether you're buying individual stocks or diversified portfolios. Let's bring this to life with a quick example. Meet Henry. Henry's a small business owner who imports goods from overseas. He's worried that the value of the dollar might drop, making his products more expensive in the future. To protect himself, he enters into a forward contract with his bank, agreeing to buy US dollars at today's exchange rate 6 months from now. This way, no matter how the market moves, he's locked in a rate and can plan ahead without the uncertainty. As you can see, derivatives are not just for Wall Street traders. They can play a role in real-world financial planning as well. But as powerful as they are, they need to be used carefully and with a clear understanding of the risks involved. To wrap up, derivatives are financial contracts whose value depends on an underlying asset or financial variable. They're used primarily for hedging risk, but they can also be used for speculative purposes. While they offer powerful tools for managing risk and enhancing returns, they can also lead to significant losses if misused. Disclaimer: this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Want to dive deeper into how derivatives fit into investment strategies or risk management techniques? Drop a comment below. I'll be responding to as many as I can. And if this content helped clarify things, don't forget to hit like and subscribe. There's more coming your way to help you take control of your financial future. If you found this helpful, you'll definitely want to check out the video on screen now. Trust me, you won't want to miss it.